Well, the markets continue to bleed out. Only a single day's respite, and we are back on defense for Wall Street, but we are back to anticipating macro risk. That wraps us up for the week and may give us a little bit more fireworks before it's all said and done. That's what we're going to focus on here. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And of course, the indicator that we're talking about here is the University of Michigan Consumer Confidence Report. It has been increasingly market moving and for good reason. I would argue it's a very prescient indicator over recent years as an input into Fed monetary policy expectations. And of course, the markets have absolutely clung to those. So we'll take a look here at what is expected and how this is all setting up to finish this roiling week for Wall Street. Just to kind of put that in context here, this is the S&P 500, the continuous contract on ES futures, just to give us a sense of what is happening here. And needless to say, it is unmistakable. Since late February, this market has been sinking like a rock, and it is growth expectations that have wrought this. If we just hold in our mind the sharp decline here, take a look at what is happening with economic growth expectations over the same period. This is the Atlanta Fed's GDP forecast, or nowcast as it were, for the first quarter. Now, we're quite a ways away from getting these figures, and there's going to be a lot more inputs into this data. So it doesn't behoove us to get stuck on actual readings and saying, oh, well, I guess the economy is going to shrink at a pace of 2 to 3%. We don't know that, I think, with good confidence here. More importantly, the direction of travel for that green line, for that the growth model, that's really what is important. That tells us that the incoming economic data that gets absorbed into this model as it comes out has been so uniformly negative that we have the model looking the way it does. So it's not so much important that we are currently in the 2 to 3% contraction range, or that we ultimately are going to end up there when the data actually comes out. What's important is the inputs into this model have produced this. And needless to say, the stock market in response has produced this. Now, when we take a look at the actual triggers, we go back to the fateful release of S&P Global PMI data on February the 21st. And we see that really the main issue here is the deteriorating service sector. And of course it is, because it is overwhelmingly the critical part of the economy. Take a look here, and we see that the composite index that takes in both manufacturing and services is largely moving in lockstep with the service sector line, whereas manufacturing is kind of off on its own journey. And although manufacturing has rebounded here from about the middle of last year going into this year, the most recent gains chalked up to manufacturers front-running a broader conflict on trade, more tariffs, more expensive inputs and imports. The pickup there then eyed as temporary, but nevertheless there it is. It is not doing a very good job offsetting malaise in the service sector, which, again, as you read this survey, is linked to the very same thing, only here it is uncertainty facing enterprises amid this sort of volatility in trade and other elements of fiscal policy, and that giving us a sharp slowdown in the In the service sector, first of all, we can see the orange line moving swiftly lower. 50 here is neutral, so at 51, we're still growing a little bit, but obviously we're within a hair of standstill, whereas just in December, the service sector was absolutely soaring, as strong as anything we've seen going back to early 2022. So the response has been unmistakable, and of course that has given us a sharp decline in the overall growth rate down to 51.6, referencing here about the middle of last year. So this is how we end up where we are. Data we saw this week seem to reinforce that more of the same is occurring here under the surface of inflation data. As we can see, the CPI report coming in a little bit softer than expected. 3.2% was seen for the core. It actually came in at 3.1. The headline down to 2.8 versus 2.9 expected. And we can see it visually here, but we can look at the breakdown in cleaner sort of table form here. And we can see that the overwhelming majority of inflation still is within the service sector. 2.49 percentage points of the overall 2.8 move in headline CPI comes from core services. That is to say, service sector excluding food and energy. Not surprisingly, the Fed is then focused right here. And of course, this is also the place where we are seeing this consternation, right here. And so it is certainly noteworthy to consider here. This is meaningful disinflation from 2.62 to 2.49. In fact, if we look at the changes month on month in this CPI report, here's the move down in headline and in core, and we can see the meat of it comes from this adjustment in the core service sector. The contribution from goods is basically unchanged. The contribution from food is basically unchanged. The contribution from energy is a little bit soggier month on month, but so we can see it's not altogether huge of a change. So we had a slightly positive contribution. Now we have a basically flat-ish one. So not really a big swing here. So all of the focus in this area, and of course that this was a big driver of the shift, tells you much the same story as what you got from these PMIs, that it is in fact the service sector that is now coming unstuck. And while that is bringing down inflation, it is bringing it down for all the wrong reasons. This seems to reinforce the idea that there is in fact some sort of a meaningful downturn that's brewing at the heart of the U.S. economy, and certainly starts to make this look, again, if not in terms of level, then in terms of trend, validated, and again, helps to understand why the markets have decided this was where they wanted to be going. Now, not surprisingly, all of this weakness has translated into a dovish shift in Fed monetary policy expectations. As we can very clearly see here, the market has gone from about 50 basis points just a month ago, priced in for this year and for next in total. We're out to 93 basis points now, with almost 3 rate cuts, 71 basis points out of 75 fully baked in for this year, and nearly a full rate cut, 22 basis points out of 25 baked in for next year. If we take a look here at what this means as far as timing, we can see we arrive at a cut fully priced in by around July. So somewhere June, July or so is where the change happens. We can see about halfway there is baked in June. So we're about 50-50 for this rate cut here. And it's all the way there by July. So as we look at the path forward here, we can see the curve has clearly shifted to a more dovish setting. As a matter of fact, we are now the most dovish in terms of the 1 year path here that we've been since the kind of major revision between September and November, where the Fed was judged by the markets to be too dovish. And this then is what sets us up for the next step. And that, of course, comes to us by way of this U.S. consumer confidence data that we have been talking about. And the expectations are anything but encouraging. So here is that data, and we can clearly see here already there has been significant deterioration in sentiment. The numbers here showing us already that we have a meaningful move lower. As a matter of fact, the numbers that we had here for February already were pointing to the gloomiest setting since November 2023, as we saw that jump in 1 year inflation expectations to 4.3%. And not surprisingly, it's not only the PMIs that have flagged this. If we look at the rationale, the February survey mainly cites uncertainty about tariffs and the implication of that for the price of goods. Needless to say, people are looking at this and saying, well, it looks like we are going to have higher import prices, and that's going to give us much faster inflation over the coming year. So needless to say, this is a source of significant concern because, of course, we already have a situation where the breakdown of GDP is overwhelmingly tilted to consumption. So if we're concerned about economic growth and we get a further deterioration in consumer confidence when consumption averages close to 70% of GDP, then those recession fears have much firmer standing. So if we look at the expectations here, we're looking for a further downtick to 63.1. That would be a 16-month low. So as we consider then what the implications would be, the obvious question is, well, how likely is it that things get meaningfully worse as a first step? And if we look at the sectoral breakdown that we get from S&P Global PMI data, it's hardly encouraging. So you can see here from January to February, the consumer goods side of things actually picked up pace a little bit. But as we very clearly learn here, there's very little demand pull on the good side. The good side is not a big part of the economic activity story here. As we can very clearly again see from the CPI report, it's all in services. And what's going on in services? Well, we went from very robust growth in January down to near standstill in February. So we were well over 50, in fact, a little bit north of 55 on this this PMI reading on the services side, and we are very close to hugging 50 for February's numbers. So that does not bode well. If all of what's happening in the consumer sector, of which services is a much bigger chunk, much as the rest of the economy, is telling us that there's heavy deterioration, even as there's a little bit of improvement here. This is the much weightier part of the story. Well, then chances are consumers are quite gloomy when this survey is taken, and indeed we are probably looking at further negativity. As a matter of fact, U.S. economic data, as we can tell from these analytics from Citigroup, telltale as they are, has increasingly disappointed relative to forecasts. And that, of course, suggests that analysts' models are not fully appreciating the level of economic deterioration out there, and so their forecasts are rosier than what realized results end up looking like when they come in. So this tilts the bias in favor of still more downside surprises, at least until there is some kind of a revision to these models. And there's no evidence of that here, as we remain below zero on this Citigroup surprise index. That is to say, we continue to be biased toward downside surprises. So with that in mind, the risk is that we end up with even softer sentiment, and perhaps that echoes into inflation expectations too. We'll see if that continues. But if we do get this kind of outcome, then the markets perhaps have more room for dovish myth-making here, since we have a Federal Reserve policy announcement due next week. Markets might take this opportunity to say, well, we know the Fed has been resistant and has argued for some sort of stasis for now, but with the situation looking increasingly like the underpinnings of the economy are unraveling and consumers are turning gloomy and responding, if that's indeed what we end up seeing, it would make sense that maybe the Fed could have its arm twisted to some kind of dovish signaling with next week's announcement that probably doesn't give us a rate cut, and indeed the markets aren't pricing one in. You can see here we're at standstill here from 438 to 432, at least through April at this point. But having said that, we are still open for a summary of economic projections that might send a more dovish message, some sort of messaging at the press conference after the FOMC announcement that introduces perhaps a recognition of what the markets clearly seem to be seeing here. And so if we then end up against that backdrop with a weaker sentiment number, then perhaps we get a little bit further out on this dovish outlook. And then, of course, the stage is set for bonds to continue marching higher, for the dollar to weaken against most of its major counterparts as yield spreads turn further against it. And stock markets have to make a decision. If, in fact, the prospect of slightly cheaper money, at least as far as the market's expectations are concerned, if that ends up being encouraging enough, at least in the near term, then perhaps the selling pauses somewhere here. But if instead what you end up with is the sense that we're getting more dovish speculation for all the wrong reasons, and growth concerns are what is front and center, then a further extension lower through the 5,500 level may well be in the cards. And of course, that would extrapolate out to risk aversion across the other major indices and equities wide. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Likewise, on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for the Price of Truth on Tuesdays, writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money will be back next week. Happy trading.